Hi everyone, today is Thursday, August 7th, and it's in the morning, and I'm going to do this in one shot here because I do have to leave in a few minutes for the airport, so I may make some mistakes, and we're just going to go through it. Got a whiteboard full of notes here. I want to give you a brief update. We last did a video on, it was June 26th, so about 5 weeks ago. We're now a week into August. I'm going to quickly wrap up the summer here in the next 3 weeks. And I just want to go a little bit since that last video. So we came out in that video changing our posture from being the market having a full year upward bias, kind of thought around the 10% level, to with all of the action happening in the second half of the year, which we're now in. The first half of the year would be corrective in nature. We had that violent 25% correction into the April 7th low, and since then it's been gangbusters straight up. The market's up over 35% since that bottom. And again, the market shot up like a rocket from a V bottom, and it's exactly why you stay the course when you don't think something bigger is at hand. It's just a normal correction. We were very overbought at the last video, so even though we're immensely positive now, the dynamics going on in the market and the economy and what's going on in the world are extremely strong for stocks, especially US stocks. But the market was overbought at that point. We wanted to see it roll down. We really didn't get much of a roll down until just last week. We had about a 3.5% correction last week that took the steam off of the frothiness out of the market, and we went from an overbought market when we did the last video to now we're neutral. We're not oversold. The market is not a screaming buy right now. We'd be really playing it cautiously going into the market, but yeah, so we're still, we remain extremely bullish on the market over the next several years. That being said, the market is very expensive, trading at high PEs, so you're going to have to be prepared. All investors are going to have to be prepared for some violent corrections along the way. So the market setup, we said this before, we're going to go through the things that we really like in here. We like the cash stockpile on the sidelines is huge. That means every time you see a market roll over, money's going to start getting sucked in. And anyone short this market is going to have to cover on those dips because it's going to go just as violently up as it goes down. Corporate earnings are coming out now. Second quarter earnings, they're very strong, especially in some of the tech sectors, the energy sector. I mean, it's incredibly bullish what's going on in corporate America. And then you've got this fundamental underlying artificial intelligence build out that has multi-dimensions, and we're actually investing in all of them. There's some really great, we'll do that in a few minutes. But this thing is going to go on for decades. Kind of like, the market for the internet started in 1995, let's call it. And even though the market peaked in early 2000 and corrected, almost 90% in technology, it would go on for another, even till today, but another 20 years of building up in internet, email, Wi-Fi, cell phones, all the stuff we take for granted right now. Quickly on interest rates, we've been predicting all along we'd get 2 to 3 Fed cuts. There were a lot of pundits out there, a lot of economists saying no cuts this year. We always say stuff at the beginning of the year. We kind of stick with it unless something really, really changes. But, we went last video from saying 2 cuts to 3 cuts now. I still feel good about that. I think you're going to get one in 25 basis point cuts, right? 0.25 of a percentage point. You're going to get one in September, October, and December. That is because, we got a revision to the employment rate. The employment is certainly softening. The housing market is really tough in certain parts of the country, particularly Florida, which is normally a booming market post-COVID. That is now really tough to sell a property there. And mortgage rates are just too high. Home equity lines too high. Car loans too high. Student loans still up there. So we do want to see a rate cut, and we're going to get it one way or the other. I think Powell starts cutting come September. They're going to announce it probably at Jackson Hole later this month. That's a conference the Fed does every August. They usually make major announcement there, so that's coming up. But even though they're going to cut rates, we don't think all rates are going to go lower. I do think the curve steepens, and what that means is that short-term rates, which right now are very high, are going to go down dramatically, and long-term rates are going to go up, and you get this steep yield curve from 1-year notes all the way up to 30-year bonds. So what we're doing to play that is we are buying the kind of like call it the summer of 2028 and summer of 2029. And the idea there is if we don't get rate cuts this fall by Powell, we're certainly get him when his term expires in May. I think Waller is going to be the front runner for the next Fed chairman. He'll probably be announced sometime soon, but it's probably going to be him because I think Trump wants to keep Kevin Hashnet on his staff, for the foreseeable future. So we're buying in the summer of 28 and 29 because by next May, those bonds, which are now 3- and 4-year bonds, are going to be 2-year and 3-year notes as time goes on. And we think the curve is going to steepen, so we're going to get some price appreciation as those bonds, roll down the yield curve. the other reason for this setup in the market is valuations are just misunderstood. Eventually, price earnings metrics are going to matter, and they're going to have to the market's going to have to correct down to let the PE multiples, price earnings multiples, correct. But most people, most pundits, are completely messing up this market. They avoided stocks like Nvidia. That's our number one position, 5 years ago, because they didn't understand. It didn't make sense in the price earnings multiple. They're missing Palantir now because they don't understand it's trading at 200 times next year's earnings. That is insane on a price earnings basis. But the company is throwing off so much cash. It's growing so rapidly, and their profit margins are up near 50% profit margin. So if they're growing their profits growth, the revenue growth is growing at 45%, and their margins are 48%. These guys are just minting money. So and the stock's going to reflect that. You have to look at it like how we were buying Tesla back in 2013 when it was a very misunderstood company. And, the only reason we learned how to do that was our investment in Celgene over the many years, which was another rapidly growing company that was trading way above its price earnings multiple. And the way we look at these is you do have to look at stocks like this as a biotech company. Like for Tesla in 2013, if you had to look at it like a biotech company. So pretend you have a biotech company that has a drug in phase 3 trials, and if it gets FDA approval, the stock's worth $1,000. And if it doesn't, it's not worthless, but it's worth $10 a share. And that's your dynamic. It's either worth $1,000 a share or $10 a share. And without me answering, just what would you pay for that? And it gets away from certain multiples and it gets more into probabilities. So the more we can drill down and be certain of the probabilities, the more certain we can bet that it's probably going to hit 1,000 and not 10. But what do you pay? You pay somewhere, not quite 50%, $500 a share, but you might pay $450 a share. And that takes out, the PE can't measure that. That being said, we expect what happened with Nvidia to happen to Palantir. Nvidia is now a $4 trillion company, over that, 4.3 trillion. Palantir is just hit 400 billion this week. The Dow is off about 250 points right now. Both those stocks are up, as the whole sector. So we think that's how you're supposed to look at it. The themes we are investing in right now in our portfolios, there are a few. They're pretty concentrated. You are seeing some of our classic great stocks like Home Depot, Illinois Tool Works, MasterCard, Berkshire Hathaway. These stocks are really not doing as much as sort of this tech focus. So our main themes are the AI build out that we think is going to be going on for decades. And we're investing that through artificial intelligence infrastructure, chips, GPUs, data centers, switches, very high complex switches. There are companies that we're in that handle that. Then we're also investing in artificial intelligence software. These are government, business, and consumer application software. Eventually, AI is going to be in everyone's pocket, just like your cell phone. We're investing in space and defense with a lot of focus on artificial intelligence, programming drones. That's the new modern warfare. So we've found nice companies and pockets in there with some high potential. Again, but high risk. The AI energy infrastructure trade, it's nuclear and it's a lot of high tech energy development and companies in there. And I can rattle off the names. We'll do that in another post. And lastly, and above all else, cybersecurity is huge. And we have a favorite name, but we're investing in about 3 in that sector. So our core 20 portfolio we did at the beginning of the year, it's up. Before today, it was up about 12.5%. The S&P was up about 7.5%, 8%. So we're outperforming there. We blew it away last year too, the market. We are going to be dropping one of our stocks. We're having trouble with that 20th position. We dropped the stock a couple of months ago. Salesforce, we added in Qualcomm. I'm struggling with that name. I need to see where they fit in better in this whole AI build out. They're involved, but it may not be as certain as some of the other sectors. But we're going to go from our core 20, we're going to drop 1, add 4 more. We're going to go to core 24. I like the way it sounds, right? So we're going to post those later. I want to keep those new 5 stocks a little proprietary until we build them out through the client base. And then we'll roll out a post online sometime in the next few weeks. So that's it for today. This market can pull back at any time. We are prepared for that. You should be prepared for that. I want to talk for a second before I leave on high water marking. Everybody, we notice high water marks. What that means is you get a statement when the market's at an all-time high and you see your portfolio at an all-time high and you put that in your mind. And we could take someone with $1 million when they started with us, and today it's worth $2 million. And if it drops to 1.8 million, rather than saying I've made $800,000, they say I've lost 200,000 and they feel miserable. That's called high water marking. What I would recommend people do to get away from that, what I do with my own portfolio and really recommend, is that stocks are a moving, living, breathing thing. These are businesses contracting and expanding, the economy contracting and expanding. Instead of looking at your statement amount, take 10% off of it. So if you have a $2 million portfolio, just in your mind say, well, it's worth 1.8. If you have $1 million portfolio, just say it's worth, $800 or $900,000. $10,000 portfolio, take off 10%, take off $1,000. It's worth $9,000 in your head. Because that is probably the average value in the short term. Over the long term, these gains will stack up on top of each other. So we just want to leave you with that. I have to get out of here. Hope everyone has a nice rest of the week, and we'll talk to you real soon. Have a great day. Bye.